Well, taking a look at futures this morning, as you can see, the Dow is down 266. This is United Healthcare. Earnings coming out, and that is pushing the Dow lower. So we've seen an escalation there. We also got Dow component Boeing in the last hour. Mixed story kind of there. Let's take a look at yields right now. The U.S. economy did expand at its fastest pace in 2 years in the third quarter. That was driven by strong consumer spending, AI investment. Right now, as you can see, the 10-year is at 4.233%. President Trump rolling out his 2026 affordability agenda aimed at lowering costs for American households. The focus on bringing down credit card and mortgage rates. I want to bring in the Lindsey Group CEO and former National Economic Council Director, Larry Lindsey. Larry, it's great to see you. So let's talk about this because, you know, all of these different moves that the administration made, not just from the big, beautiful bill, which those advantages will come into play this year for businesses and individuals, but then also looking at things like the $200 billion buyback from Fannie Freddie, the purchase anyway of mortgage-backed security bonds, the 50-year mortgage, dealing with investors, you know, taking up American homes when it should be Americans and small families buying those homes. I mean, all of these policies do seem to point to a strong U.S. economy for 2026. What is your outlook?
We agree completely with that view. I think what people are missing is just how big a productivity surge we've had in the last 3 quarters. That's been 4.6%, which is enormous. The average for the 21st century is just 2%. And so we're likely to come in with a real GDP growth in 2025 of something over 3, slightly over 3%. I think we're going to have roughly the same kind of growth in 2026. This productivity surge is, everyone talks about a soft labor market. Well, we may not have a lot of job gains, but we still have very fast growth. And the definition of productivity is more output with less input.
Well, you know, Commerce Secretary Howard Lutnick joined Maria last week in Davos to talk about the administration's plans, the work that they've been doing, and obviously the work that is ahead. Listen to what he told her.
What would be your expectation for economic growth this quarter, first quarter?
So I think this quarter, the first quarter of 2026, the United States of America's $30 trillion economy will exceed 5% growth.
Wow, 5%.
Exceed 5%. And if we get a new Fed chair, which we'll get this summer, and they cut rates, which they should, because why is the greatest credit in the world paying the highest rates? You saw the 10-year, right? We just looked at it. 4.25. We are 200 basis points higher than anybody else in the world, and we're the best credit. If they cut that rate, you're going to see the end of 2026. You're going to see 6% growth from the United States of America.
Wow. So the Federal Reserve does kick off its first policy meeting of the year today. Central bank is expected to hold rates steady after 3 consecutive cuts at the end of last year, and then any guidance we get on future rate cuts. And then, of course, the comments from Federal Reserve Chairman Jerome Powell. Your thoughts here?
Well, first of all, I think Secretary Lutnick is doing his job, which is to be a little bit of a cheerleader there. We have a chance of getting a 5% quarter, but I don't think the productivity surge is quite enough to sustain that for the whole year. Again, I would look for roughly 3% growth this year. As to the Fed, when you have rapid growth, you have much higher demand for capital. And when you have higher demand for capital, the natural tendency is for rates to go up. And I think that just to look at the Fed's math, right, they have what they call an R star, which is a neutral real rate of 1. They hope to get inflation down to 2, which suggests that they should have a 3% floor on their Fed funds rate. You know, that's just 2 cuts. I'm sure the next Fed chair will bring in 1. They may bring in 2. But once you go beyond that, you're getting into extremely accommodative territory at a time when you have very rapid growth and very rapid demand for credit. And I don't think that's a wise move.
Well, but that seems to be the consensus. I want to bring in Ashley Davis from Washington, where you sit in Washington. I mean, we've kind of narrowed it down to it was the tale of 2 Kevins. Now it's, you know, it's Kevin Warsh, and then you've got Rick Reeder. Obviously, that decision of who's going to be the next Fed chair. But either way, Ashley, we've had several guests already this morning say that person is going to be dovish, and you're going to get more cuts. Your thoughts?
Well, yeah, and Larry and I used to actually work together back in the Bush administration days. I was in awe of him at 26 years old. So, Larry, I love you. But listen, yeah, and we both know Kevin Hassett from those days as well. But, yeah, I guess my big question to you, Larry, is what do you think about the regulation that has been cut by this administration? I mean, in my days, we weren't able to do that when we were in the White House. But, I mean, what's been able to be done has really been able to bring jobs back here, really move the market. Do you think that's sustainable?
Well, I think the deregulation pace will continue. There's a lot to do, particularly in the housing and construction sectors, and the energy sector is continuing. But again, what I think is driving the market now is the very natural tendency of firms to want to economize. They now feel they don't need to have excess workers like we did after COVID. They're letting them go, so employment demand is down. AI has certainly affected the number of supervisory workers in the economy. You know, non-supervisory workers last year, I hate to throw so many statistics out, but non-supervisory employment or hours went up by a full percentage point, which is significant. But supervisors went down by 0.7%, because what AI is doing is it's very good at statistically analyzing what's going on in the firm. And so the number of supervisors, I think, will continue to drop. That will lower costs, and that is what's enhancing productivity.
We shall see when we get the take from the Fed tomorrow on the state of the U.S. economy. Larry Lindsey, thank you for being here, Larry.
My pleasure.